In this lesson, we're going to discuss one other reason that a company might need to make a change to its financial statements, to correct an error. Changes in principle and changes in estimate were legitimate choices. An error is different. The company simply got it wrong. Expenses in the wrong year, revenue recognized too early, an asset expensed instead of capitalized. The goal here is to understand the impact that an error has on net income and retained earnings and how to fix it. I'm going to show you how one simple schedule can help you untangle any error and build the correcting journal entry. Imagine you're an accountant for a public company. It's mid-March and the audit is underway. One of the auditors comes into your office with the discovery that you forgot to accrue $8,000 of salaries at the end of December. It's an honest mistake, but now that you know, how do you fix it? Last year's books are closed. The financial statements are published. You can't unring the bell. So what now? GAAP calls for a prior period adjustment, which is the technical term for fixed retained earnings. But before you can correct anything, you have to understand exactly what the error did to each year separately. Did it affect revenue and expense accounts last year, this year, both? To answer that question and correct any error, I want you to build the same little schedule every single time. 2 rows, 1 column per year. Top row, what the company did, the revenue or expense it actually recorded year by year. The bottom row, what the company should have done under GAAP. The difference between the rows year by year is the effect of the error on that year's income. A year where they under-expensed is a year income is overstated. A year where they over-expensed, income is understated. Here's a did-should table depicting an error related to an insurance policy. In year 1, the company paid $2,000 for a 4-year insurance policy and expensed the entire thing immediately. What they did, $2,000 of expense in year 1, 0 in years 2, 3, and 4. What they should have done, $500 a year in expense for 4 years. Differences, year 1 income is understated by $1,500. Years 2, 3, and 4 each overstated net income by $500. And here's the bonus, the schedule hands you for free. At any date, the sum of the differences so far tells you exactly how misstated retained earnings is at that date, and the remaining prepaid insurance that should be on the balance sheet. For example, at the end of year 2, notice the sum of the differences would be a $1,500 understatement plus a $500 overstatement. Those 2 errors are what's sitting in retained earnings right now. Add them together and we would know that retained earnings at the end of year 2 is understated by $1,000. The difference in the year 2 column, though, the $500 overstatement, that's what's wrong with net income in year 2. One schedule answers every question the problem can ask. Income effect in any year and retained earnings effect at any date. Notice something else. What happened across the 4 years combined? Income was understated by $1,500 in the first year, but then overstated by $500 for 3 years. By the end of year 4, retained earnings is exactly right again. The error washes out over the 4 years. So if errors wash out over time, then most honest errors fix themselves eventually. But many of them wash out in exactly 2 years. Wrong in one direction this year, wrong in the other direction next year. We call these counterbalancing errors. Missed accruals, prepaid expenses fully expensed the year before the coverage, revenue recorded a year early, and inventory misstatements, which always hits cost of goods sold one way in the first year and the opposite way in the next. But be careful with what counterbalancing does not mean. It does not mean the financial statements were fine. Both years' income numbers were wrong, and if either is shown comparatively, it still must be restated. But on the positive side, once the books of the second year are closed, retained earnings needs no fixing. It's right. And if there's no balance sheet account still misstated, no correcting entry is required at all. Errors that don't counterbalance, like our insurance policy, keep retained earnings wrong for years and always need an entry. The correcting journal entry follows from the schedule in 2 questions. Question 1, which balance sheet accounts are wrong right now? Fix them to what they should be. Question 2, where did the offsetting income effect land? If something was wrong with a prior year, we have to fix retained earnings. But what do we do with the current year's effect? Depends on whether we've closed the books or not. If we have, then all of our temporary revenue and expense accounts have been closed to retained earnings, and that's where our correction for this year should go as well. If the books are still open, though, then the correcting entry goes to the actual revenue or expense accounts. Let's look at a few examples. During Comrade Company's Year 3 audit, 6 errors were discovered, ranging from the missed salary accrual to rent collected in advance, booked as revenue. inventory misstatements, and a big one, a machine expensed at purchase and then its sale proceeds recorded as income. For each error, we're going to build the did versus should schedule, total the effect on year 3 income, and then write the correcting entries twice, once assuming the books are open and once assuming that they're closed. Before we begin correcting our 6 errors, notice that they've given us this information for year 3. They've told us that during the year 3 annual audit, that's when the errors were identified. That's important for how we answer the questions going forward, is to know which year we are in. Error number 1 says that the company failed to make an adjusting entry at the end of year 2 to accrue salaries. Expense of $8,000. So in our did should chart, we're going to say, what did they do in year 2? They did nothing. I'm going to put a 0 here. What should they have done? I'm going to put a negative 8,000. They should have recognized a negative 8,000 an expense. So the negative identifies it as an expense. In year 3, what did they do? That's when they recognized the expense, when those salaries were paid, but they should have recognized them when the salaries were earned. So they should not have recognized anything in year 3. I'm going to put a 0 here. So when you're asked what to do to correct the entry, if you're told that the books are open, what you can do then is think of drawing a line, right, where the books are closed and thinking of everything to the left of the line being in retained earnings already. So anything that's wrong with my revenue or expense accounts prior to this line are already in, all those errors are already in retained earnings. So to fix anything before the line, I'm going to need to make an entry to retained earnings. Now, when I'm looking at the current year and the books are open though, what's wrong with the current year is in this column. It's an $8,000 expense that we recognize that we should not have. So really we need to add $8,000 back to our net income. Our net income is understated by $8,000. We need to add $8,000 back. So I'm going to make a journal entry to fix this. And to start, I need to fix the expense that I should have recognized last year. So I'm going to debit retained earnings. That's to the left of the line for the error of $8,000. Now, the credit for year 3 to fix year 3, where the books are currently open, is to reverse this salaries expense that I did recognize that I should not have. You can be asked a number of questions here. You could be asked to make the correcting entry. You could be asked what is wrong with retained earnings. You could be asked what's wrong with net income, or you could be asked what is the correct net income, in which case you would need to add back this $8,000. If they asked you what's wrong with retained earnings at the beginning of year 3, you would know that it was an $8,000 overstatement of retained earnings because it's missing an expense. They should have recognized an expense. If they were to ask you what's wrong with retained earnings at the end of year 3, I would put my line over here, and everything to the left of this line would be what was wrong with retained earnings at the end of year 3. So in that case, it would be counterbalanced. So our correcting entry, if the books are closed, that red line represents the closed books. Everything to the left of it is what's wrong. And I don't need to do anything because this is a counterbalanced error. So I'm going to say no entry here. Error is counterbalanced. Now let's look at that insurance policy that we've already talked about and fill out our did-should chart. It was a $2,000 insurance policy that was improperly expensed in year 2. So they recognized $2,000 of expense in year 2 when they should not have. Instead, they should have recognized the $2,000 of expense over 4 years. So they should have had a negative 500 here and a negative 500 here. And in each of those 4 years, we would have a $500 expense. So that's our did-should chart for this insurance policy. To correct this, I need to think about whether my books are open. So in year 3, if the books are open, I'm going to draw my red line right here, right? This is where the books have been closed. They were closed at the end of year 2. So anything to the left of this line is what's wrong with retained earnings. Anything to the right of this line is either wrong with the current year revenue expense accounts or potentially balance sheet accounts for the future years. So we've got both here. So the year 3 books are open. I need to record expense, right? In year 3, I've done nothing and I should be recognizing expense. So I need to recognize insurance expense of $500. And then I also need to recognize some prepaid insurance for these future years, years 4 and 5. So I'm going to debit prepaid insurance for $1,000. And then finally, I need to fix what's wrong with everything to the left of the line. So I'm going to credit retained earnings because retained earnings has $1,500 too much expense in it. So that needs to be added back. Another way you can think about this row right here, that we've calculated, our difference row, is what we need to do to net income in any one of the current years. So if I'm in year 3, I need to subtract $500. If I were in year 4, I would need to subtract $500. If I'm in year 2, I need to add back $1,500. But we are in year 3, which is why that's bolded and red. So to fix the entry if the books are closed, again, let's go ahead and move this line to where the books are closed. Everything to the left of it is what's wrong with retained earnings. Everything to the right of it is what's wrong with balance sheet accounts. So I still need to record that prepaid insurance for $1,000. But now I can correct retained earnings for, again, whatever's to the left of the line. So the sum of the error to the left of the line is what's been closed to retained earnings. In 1 year, I needed to add back $1,500, but then in year 3, I needed to subtract $500. So that net amount is $1,000. So that's my correcting journal entry for the books being closed. Next error is that the company recorded rent received in advance as revenue in year 2. Those rental payments that were received, what they did was record $6,000 of revenue, but what they should have done was recognize that revenue over a 2-year period. And so I would have recognized $3,000 in each year if I wanted to do that correctly. Again, I can look at this row right here as what I would do to net income, what I would do to fix net income. If I was in year 2, I'd be subtracting $3,000 because I had recognized $3,000 too much of revenue. But I'm in year 3, so what would I do to net income? I need to add $3,000 and recognize $3,000 of income. So if my books are open, I can do that, right? I would draw my line right here. My books are open, so this is where they're closed. And I need to fix retained earnings and rent revenue. So I'm going to go ahead and debit retained earnings. And I know that it's a debit because that is a negative number to the left of that line. I need to subtract out $3,000. And I know I also, to the right of the line or in the column for year 3, I need to recognize $3,000 of income. So I'm going to credit rent revenue for $3,000. And so it does help to know what's going on here, what the journal entry should have looked like, and what accounts would be affected. But notice that if the books are closed to the left of this line, everything sums to 0. So if the books are closed, no entry is needed. The error has been counterbalanced. Our 4th error says interest revenue was accrued in year 2 when it wasn't earned until year 3. So we did recognize $1,500 of interest revenue. We should have not done that. In year 3, we did nothing, but we should have recognized $1,500 of revenue. So to fix this, if my books are open, they were closed here. Everything to the left of the line is what's wrong with retained earnings. Everything in the column for year 3 is what's wrong with current year revenue and expense accounts. And I don't have any future years affected, so I don't need any other balance sheet accounts. So the first thing I'm going to do is fix retained earnings because I see a negative number to the left of that line. So that means I'm going to need a debit to retained earnings to decrease it in the amount of $1,500. And then to the right of the line or in the column for the year that we're currently in is a positive number. I need to record a positive income item in year 3. Specifically, we'll call that interest revenue of $1,500. Now also this entry, just like before, if the books are closed, can be thought of as counterbalance because the sum is 0. So no correcting entry if the books are closed because the error has been counterbalanced. All right, here's 2 errors in 1, and it's very important that you understand that this is 2 errors. They told me that I had an understatement in ending inventory in year 1 and an overstatement in ending inventory in year 2. Well, if there were an understatement in ending inventory in year 1, in year 2, it would turn into an overstatement. So by year 3, that error would have counterbalanced, and I don't care about it. So in the year 2 overstatement, however, I did nothing, and I should have recorded $1,850 of cost of goods sold because my ending inventory is overstated. Now that error will carry forward to year 3 as something I did record. I did record $1,850 of cost of goods sold when I should not have. That should have belonged to the prior year. So again, books open. Everything to the left of the line is what's wrong with retained earnings, and everything in my column for year 3 is what's wrong with this year's net income. So I see a negative number before line, and so that means I need a debit to retained earnings of $1,850. And then I also need to fix cost of goods sold in the current year. I've debited cost of goods sold for $1,850 when I should not have. So I'm going to credit cost of goods sold And just like before, you'll notice that if the books were closed at the end of year 3, then that error would have counterbalanced and no entry would be required. In error number 6, we have a machine that was $1,200 that was purchased in year 1, and it was improperly expensed on the date of purchase. So what did they do? They expensed $1,200. What should they have done? They should have expensed that $1,200 over the course of 4 years. So each of these 4 years should have a $300 expense in them. And we can see here that after 4 years, the error would wash out to 0. But in the current year, we should be recording $300 of expense, but we actually did nothing. So to correct this entry in year 3, if the books are still open, notice everything to the left of the line would be what's wrong with retained earnings. So I need to recognize some expense in the current year. I also need to have an asset that I've improperly expensed and never capitalized. So I'm going to record the asset first. I know I need to debit asset for $1,200. Then I also know I need to record depreciation expense in the current year. That's a debit. So I'm going to go ahead and record the depreciation expense in the current year of $300. Now, what is wrong with everything to the left of the line is $600 that was recognized an expense that should be added back. And so I need to credit retained earnings for $600. And then my accumulated depreciation account at the end of year 3 should have $900 in it as a result. So I also need to credit accumulated depreciation for $900. Now, if my books were closed at the end of year 3, we can move all of this over to here, and everything to the left of the line is what's wrong with retained earnings, and everything to the right of the line is a future year that we don't have to worry about until we're in year 4. So we are in year 3. To correct this entry, we would still need to debit an asset for $1,200. So I'll take that $1,200 from here. And I would also need to fix retained earnings. So I'm going to credit retained earnings. How much for? Well, I'll just sum together all of the effects of the error in the prior 3 years, everything to the left of the line, to get a credit for $300. So again, I summed together all of those errors. Then finally, I do need to have an accumulated depreciation account established. And that should have $900 in it at this point because I should have recognized 3 years of depreciation. Next year, I'll just recognize another $300 of depreciation expense and go from there. Notice here that if the problem had asked me what was the effect of all of these errors on current net income, I would take the amount from the difference column in each year 3 column. In the first error, I needed to add back $8,000 because I'd recognized too much expense. In the second error, I had overstated net income. I didn't record insurance expense that I should have, so I would subtract, and so on to get a total understatement of $13,550. Summarize the rules here. Most errors require a prior period adjustment to retained earnings and restatement of the financial statements. Using a did versus should schedule tells you the income effect of the error in every year, and the running total tells you the retained earnings effect at any date. Counterbalancing errors wash out of retained earnings after 2 years, and if no balance sheet account is still wrong, the answer is genuinely no entry. For everything else, fix the balance sheet accounts and retained earnings, then fix the current year's revenue and expense accounts, but only if the books are still open.